Hello, I am Wael Yahya, Certified Financial Technician Expert from the International Federation of Technical Analysts. In this video, we will update our classical technical analysis view over the short term for the euro-dollar currency. First of all, we will check the major structure over the monthly chart. Then we will see the long and medium-term picture over the weekly chart. Finally, we will explore the details over the short-term details over the daily chart. Let's go. Here is the monthly chart, and we can see that it was getting into a major downtrend for some time, and this major downtrend was since 2009. And it consisted, of course, of lower highs as well as lower lows. But some shift took place, a kind of shift took place. Maybe a trading range was in the process of formation, consisting of horizontal resistance around 1.24 level and a horizontal support around 1.05 level, and this number is very important, 1.05. This is critical for the major structure. As long as the euro dollar is below 1.05, it is in a bearish environment and under very strong selling pressure. The euro dollar did not manage or succeed to keep the trading range valid for more time, and as we can see, it decisively broke below 1.05. Of course, this break below 1.05 confirms the bearish environment over the long term, and as months after months close below 1.05, it becomes more and more strong resistance, and of course a lot of a move to the downside is more likely. The trading range that we were talking about that did not continue had a thickness of around 20 cents. We have previously said it's ranging from 1.05 up to 1.25 approximately. This thickness is around $0.20, which means 20 cents. So if the euro continued to close below 1.05, the minimum target of this trading range to the downside, calculated from the level of the break, will be 1.05 minus 0.20, which will be, I think, approximately 85 level. And this is what we are talking about. Continuation of closing below 1.05 will approximately lead to the 85 level over the long term. Now let's check the long and medium term picture over the weekly chart, and let us see if the picture confirms the upper time frame. We notice here that once upon a time there was an uptrend over the weekly, and it got stuck into a reversal pattern, which was a classical double top at these levels. It broke below the neckline, which was running through 1.16, and then it established a well confirmed downtrend over the weekly chart. And here it is, that's the trend line, and here is the channel line. In addition to the bearishness over the weekly chart, and in addition to the selling pressure that we can see, more added selling pressure is appearing now after the close below the channel line. And as we know, any close below the downtrend channel line is indicating much more rate of acceleration to the downside. Simply we can say it indicates much more selling pressure and a faster rate of decline. And we notice that this faster rate of decline came at the same time of breaking the monthly support at 1.05. Once again, this level is very important. Keep in mind to learn this number over the years to come, maybe 2 years, maybe 3 years. As long as the euro is below this number, things are not looking good for the European economy as well as for the euro currency. Okay, let's jump for the short-term details over the daily chart. You notice here that the upper time frame was downtrend, major downtrend, and here over the daily chart it's clear we do have short-term wave, impulsive wave to the downside. Of course, this impulsive wave is formed of moves: impulsive move, corrective move, impulsive move, corrective move, impulsive, corrective, and impulsive. So in general, this medium-term wave is considered an impulsive wave, forming a bigger or a part of the bigger time frame, which is the weekly downtrend. So I think the euro now is under selling pressure over all the time frames, major, medium, and short term. In addition, we can see that even the speculative ultra short move is also down. For now, you can notice this hammer that may indicate a kind of correction to the upside. This correction is short against the prevailing impulsive downward wave and also against the prevailing major downtrend, and it will face lots of kinds of resistance. First of all, it will face the downward channel line from the weekly chart. It will face the major horizontal resistance from the monthly chart, and it will face the downtrend line over the daily chart. It's a bunch of resistance ranging from approximately 1.04 approximately up to 1.05, and you may expect it up to 1.06. So this area will be considered as a red zone against any corrective move to the upside. And it's expected, of course, when selling pressure reappears around this area, things may turn again to the downside and targeting over the long term 85 level or the 85 cents level. So in order for the euro to regain its positivity or some kind of bullishness, it should manage to break above these levels, which is not the case and which is less likely as long as the Russian-Ukrainian war is taking place and as long as the Russian-NATO conflict is gaining much more, what you can say, factors of negativity, and as much as the US Central or Federal Bank is increasing the interest rates over the dollar. All these factors, as long as they are available, and as long as they are a fact and a reality, things are not good at all over the long term for the euro. We might see some type of correction, sometime near, sometime far, but as long as these geopolitical and financial factors are in place, things are not good at all for the euro. And technically, as long as the euro is below the zone ranging from 1.04 up to 1.06, things are also very negative and under severe selling pressure, targeting 0.85 over the long term. And don't forget, 0.5 target is calculated by subtracting the 20 cents of the monthly trading range from 1.05, which is the broken monthly support. That's it for the time being. Thank you for watching. Please like, share and subscribe, and check our videos over our channel. See you soon.